Welcome to the Retirement with and On Purpose podcast. I'm your host, Trevor Lawson, and this show is all about helping you not just reach retirement, but truly thrive in it. You've put in the work, now let's make sure you can enjoy every moment to the fullest. Today's episode is designed for helping the general public understand the value that a financial advisor can add. For so long, there's been a belief that working with an advisor, the benefit of that is so that advisor or advisory team can help you outperform the market. I mean, for a long time, people have really seen working with a financial professional as an advantage for helping them outperform the market. And we've seen over time there's only a handful of investors or investment managers that have consistently outperformed the market. It's becoming more and more rare for people to actually be able to do that. But what Vanguard started in 2001 is a concept called Vanguard Advisors Alpha. And they outlined how advisors could add value, or alpha is the technical term, alpha, through relationship-oriented services, such as providing wealth management via financial planning, discipline, and guidance, rather than by trying to outperform the market. So what Vanguard has helped bring to light is how advisors help in other ways, not necessarily by outperforming the market, but by helping investors in other ways, which can translate to real after-tax returns or differences in an investor's portfolio over time. So I'm quoting Vanguard's article here, which I'll link in the show notes. Putting a value on your value as an advisor is as subjective and unique as each individual investor. For some, the value of working with an advisor is peace of mind. For others, we found that working with an advisor can add around 3% in net returns. So net being after fees, when following the Vanguard Advisors Alpha framework for wealth management. We do not believe this potential 3% improvement can be expected annually. So let's go ahead and set the standard there. Just because you start working with myself, my team, or another advisor, don't automatically go expect 3% more per year. Rather, it is likely to be very irregular. Like any approximation, the actual amount of value added may vary significantly depending on client circumstances. Some of the best opportunities to add value occur during periods of market stress or euphoria, when clients are tempted to abandon their well-thought-out investment plans. To start 2024, there has been more market volatility than what we've seen over the past 2 years. And so it's inviting a period of stress where some may be tempted to abandon their well-thought-out investment plan. I noticed this coming off of 2 back-to-back incredible years in the market, 2023 and 2024, when the market was up over 20% both years. I noticed some clients who were historically conservative or at least moderate in their portfolio, but who may be aligned politically with the new administration versus the old, they were tempted based on the euphoria they had experienced over the prior 2 years to potentially get out ahead of their skis a little bit in their investment risk tolerance and invest more aggressively than they previously indicated they could tolerate. So it's very tempting during these periods of highs and lows in the markets without the guidance of a financial professional to to make a poor investment decision that can have a real lasting impact on your investment returns. So, what are some of the actual tangible items that Vanguard notes that an advisor can help with to improve the client's outcome? There's a couple worth noting here. So one is asset allocation. So asset allocation refers to the percentage of a portfolio invested in various asset classes such as stocks, bonds, and cash investments according to the investor's financial situation, risk tolerance, and time horizon. Asset allocation and diversification are two of the most powerful tools advisors can use to help their clients. It, again, is very tempting when we look at what's done well recently, inviting recency bias. But when we look at what's done well recently, the S&P 500, large cap U.S. companies have been one of the top performing asset classes for the past 2 years, if not the best performing asset class. So it's very tempting to perhaps allocate more and more of our investment portfolio into the S&P 500 or into these large cap US stocks that have done so well over the past 2 years. But if we go back and look at how the S&P 500 has done over a longer time span, 10, 15, 20 years, there has been years where those returns have been in the opposite direction, where it's been down 20%. And that can really hurt an investor who is now retired and living off their portfolio. So maintaining an appropriate asset allocation based on the individual investor's risk tolerance and time horizon is one of the best things advisors can do, as Vanguard notes, to drive alpha or performance for the investor. Another that was found in Vanguard study is cost-effective implementation. So cost-effective implementation is a critical component of every advisor's toolkit and is based on simple arithmetic. Gross return minus cost equals net return. So an advisor who's helping you with your investments but is using more cost-effective investment options inside of your portfolio is very beneficial for driving advisor alpha and positive client outcomes. So cost-effective implementation is another key area that advisors can help with. Thirdly, rebalancing. So I'll use the performance we've seen again with the S&P 500 in 2023, 2024. Without rebalancing, which let's define that. As investments produce different returns over time, the portfolio is likely to drift from its original target allocation. So basically, rebalancing is periodically moving money out of, in this case, over the past 2 years, if the large cap sector has done very well. So without rebalancing, the large cap sector could make up a much higher percentage of your overall portfolio if we didn't rebalance and readjust the portfolio to match your individual initial allocation. So rebalancing is essential just so we don't become overweighted or over-concentrated in one particular asset class, and so we can maintain that appropriate diversification. So an advisor or an investment team that helps with that is really beneficial. The fourth one, and in my professional opinion, is the most important one, is behavioral coaching. So I'll quote the article a couple of times to really drive this point home. But advisors need to help their clients maintain a long-term perspective and a disciplined approach, the article notes. It goes on to say emotional detachment is one of the most overlooked benefits advisors can provide. Studies have concluded that behavioral coaching can add up to approximately 2% per year of return, really by helping some investors make poor decisions when our emotions get involved. So it's very tempting, like I've already noted, when things are going well to become more aggressive with our portfolio. Or when things are not going so well and we're going through a downturn in the market, to move out of our stocks or more growth-oriented holdings into very conservative holdings. But these changes during a ever-changing volatile market can have a significant lasting impact on a client's return and portfolio's performance. So, I repeat, emotional detachment is one of the most overlooked benefits advisors can provide. And that goes for being detached from politics, which can oftentimes play into an investor's, desire in how to invest depending on who's in office. Being detached from recent market trends and what's done well recently. An advisor that can really help you kind of stick to your guns, stick to your original investment plan, regardless of all the noise going on politically or in the short term in the markets. That can really drive positive outcomes for the investor over time. Two more I'll note that Vanguard points out in their article, and then you're welcome to read the article for yourself in the show notes. But tax efficient investing. So this is simply just asset location, the allocation of assets between taxable and tax advantage accounts. So taxable accounts, think brokerage accounts or accounts that you get a 1099 for every year. Those accounts may not be the best accounts to hold a high yield bond in that's paying out interest every year that you're going to have to pay ordinary income taxes on. That may be better suited, that holding may be better suited for your tax deferred account that you're not going to have to pay taxes on until you start intentionally withdrawing money. So an advisor, an advisory team that can help you maintain a broad, diversified allocation, but ensure that the individual assets that you're holding are held in the most appropriate account is another way for the advisor to help drive alpha or client returns. And then finally is just helping clients determine the appropriate order of operations for spending down their assets. Does it make sense to potentially draw down on my 401k first that maybe is invested a certain way, or should I start drawing out of my brokerage account that's invested a different way? An advisor that can help you really develop a retirement income spending strategy and help you spend down on the most appropriate asset first can really make a difference on your performance as an investor. So more to come on this as time goes on, but Vanguard has done a very good job helping reframe how, in my opinion, the public should think about working with an advisor. It's not to help you outperform the market, but it's to help you maintain discipline and provide the behavioral coaching that can help during periods of distress or euphoria. As always, it is my pleasure to provide nuggets or food for thought, or help you, frankly, reframe things that you may have been thinking about, just to give you another way to think about it. So continue to take care of yourself, and I look forward to being with you again soon. Thanks for tuning in to the Retirement with and On Purpose podcast. I hope you're walking away with new ideas and a fresh perspective on how to make the most of your retirement journey. And remember, retirement isn't the end. It's your time to live with purpose. Until next time, I'm Trevor Lawson. Here's to a fulfilling and thriving retirement.